Hello, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend. I am going to jump right in here. A bunch of great questions, so thanks to everyone as usual. First question, I spent a lot of time with this one because I think it touched on a number of questions actually that people asked, and I think it's important to frame. I think how to think about things, or one way to think about things. It's not the only way to think about things, but I think it helps frame some of the big gears that I think we need to be thinking about as investors. And the question is from Kim Lee. It says, what is a balanced portfolio in 2022? Stocks, growth, and value, bonds, including treasuries, long and short term, cash, dollars, and other fiat, precious metals, other commodities, real estate. It also ties into a question from Astro about how to construct a portfolio, for the average 65-year-old boomer. And so I think you need to start with the setup where we are, like I just mentioned, which is to say it's historically unique. We've got the first bursting global sovereign debt bubble in 100 years, and we have peak cheap energy. And so that ultimately means is mankind is attempting to move off of a higher energy return on invested energy, or EROIE, higher EROIE energy source to a lower EROIE energy source. First time in recorded history. And so you'll frequently hear some people say, well, the Stone Age didn't end for lack of stones, which is correct. They moved to the Bronze Age because bronze was better than stone. We're trying to move from fossil fuels to energy that right now is actually less efficient. And that's a huge deal. Energy is the master resource. Energy is nature's discount rate, effectively. And so a lower EROIE means structurally higher energy costs, and that's a problem on two fronts. One, it sends inflation structurally higher, and two, it makes, because it's nature's discount rate, you're basically raising the hurdle rate, whether central bankers do it or not, for all sorts of projects and assets, and that makes a lot of debt uneconomic over time, and given debt levels, runs the risk of basically a debt deflationary spiral. And so that leads you to one of two options, really, from a policy standpoint, unless they're able to find some sort of massively better energy source and commercialize it very soon. Those two options are default or restructuring of the debt, sovereign debt, as well as a lot of other corporate muni, etc., along with obligations, or central banks have to print money and more fully reserve the debt that's outstanding, which is to say they grow their balance sheets to buy debt to keep it from defaulting and the release valve or fiat currencies globally. And we saw this in 2021, 2020 to 2021, the inflation side. And in the last 5-6 months, we've seen what happens when they just stop doing that, let alone start trying to sell debt back into the market, they being central banks. So ultimately, they have to inflate. Sovereign debt underpins the currencies. The sovereign debt, with the system as structured, also represents collateral for a lot of a very, very highly leveraged system, derivatives, etc. And so if that debt is allowed to nominally default, the entire system collapses. The backing of the currencies gets very weird. And so, simply put, default restructuring of sovereign debt is not a policy option in the end. So they have to inflate. But they're trying to sort of inflate as a way of slowly restructuring the system on the fly. Basically, sort of trying to change the tires on the car while the car's on the highway. Or as we've put it, trying to ride two horses with one ass. And so they need to consistently print more over time to more fully reserve the debt for as long as peak cheap energy continues to drive the marginal cost of an oil and fossil fuel barrel, a fossil fuel calorie, if you will, higher. But they don't want to print so much so fast so that they lose control of inflation on the upside, and then they have to institute yield curve control across much of the bond market, which is effectively just an all-at-once rapid restructuring of the debt. And that would be extraordinarily inflationary. And so, to me, ultimately, peak cheap energy is a real-world constraint that they can't print around. And that's putting constant upward pressure on commodity prices and therefore inflation. And debt levels are another constraint, both on if inflation gets too high and if inflation gets too low, risking the debt deflation death spiral. And so this space of debt of inflation too high, inflation too low, that sort of Goldilocks area is shrinking over time as energy prices rise and as debt levels rise. And eventually that Goldilocks space is going to go to zero. unless this new energy solution is found and rapidly commercialized and rolled out. And so when we think about it this way, let's bring it back to asset allocation. To me, asset allocation in the current environment is really about understanding both the end game, where they're going to have to print it, and then the optionality in the path, optionality of the path, and where one is, based on those two things, based where one is in one's lifespan and one's investment goals. And so ultimately, I think the real value, I think the real value of debt in things you need, in other words, the purchasing power of bonds over the course of this cycle, is likely to fall sharply. I think you need to be overweight things you need over the course of the cycle: commodities, real estate, equities exposed to commodities and industrials. And then I think things that do well when central banks more fully reserve debt: gold, Bitcoin. I think you want to be underweight bonds, which over the course of the cycle will likely lose significant value in real terms, as we just talked about. But anytime they don't print enough, you're going to likely see debt outperform these other asset classes for a bit, at least until the deflation involved begins to call into question the very solvency of sovereigns, and Western sovereigns in particular, along with corporates, munis, etc. Because again, they're levered and they need rising inflation and rising asset prices, particularly in the U.S., to stay solvent, to be able to basically make the interest payment fully, broadly defined, our true interest expense definition of interest plus entitlement payments. And so, for me, what this asset allocation looks like through this historically unique time is a heavy cash allocation, overweight industrial equities, overweight commodities, especially energy, underweight debt, long attractive residential real estate and vacation property, stuff that is, I think, unique or has a finite value: lake houses, ocean houses, things you can rent, cash flow, etc. I think you want to be long gold and gold miners. I think you want to be long Bitcoin. I think farmland, which has obviously done well, I think likely continues to do well. Ag, is just a derivative of energy. And so the net of it is, I think when we think about asset allocation, I think that the next 20 to 30 years are going to look very, very different than the last 30 to 40 years, especially when you start throwing the possibility / likelihood of deglobalization into this mix. If globalization was disinflationary or deflationary, it strains credulity to think that deglobalization isn't going to be inflationary. And so I would be very careful about trying to trade the end of a 50-year currency system, first bursting global sovereign debt bubble in 100 years, the first ever human shift from a higher energy return on invested energy source to a lower EROIE source, and deglobalization. When you combine all of these things, I think trying to trade what is happening is likely to be a fool's errand, unfortunately. And I think this chart we've showed before of what gold did in Weimar Germany is a perfect example. Yes, gold in German Reichsmarks went from basically 1 to 1 trillion over 5 years. But if you were levered, you lost all your money 4 or 5 different times. The volatility was just face peeling. And so I think it's important to stay low over your skis. The asset allocations we talked about before is, I think, again, adjusted for lifespan, where you are, your investment goals are how I'm thinking about things at the moment. Next question, Tom. Luke, what strategy do you give the average middle-class person in the given environment? Kind of ties on to the first point. I think in addition to the points made before about asset allocation and what a unique environment this is, I think entrepreneurship wins over the course of this cycle. I think the internet levels the playing field, particularly in content-related businesses versus bigger corporate competitors. And I think you find a niche and you exploit it to the best of your abilities. Alternatively, there's a lot of boomers retiring. I've heard probably 3 or 4 different times in the last year, baby boomers that want to retire, they own a business, they would love to sell it, they can't find a buyer for their business. And so I think if I wasn't doing this, I'd be tempted to raise money or deploy my own capital, making a deal with a baby boomer to buy their business from them, pay them a retainer for a year to act as a consultant, teach me the business, and then expand after they retire, and boom, you have your own business. I just think a lot of businesses that are sort of small, mid-sized, they're too small to be getting bid up by private equity, and there's a lot of boomers looking to cash out. Not as many people looking to buy them, and so I think that's a potential opportunity as well when you think about entrepreneurship over the next 5 to 10 years. Next question is from FM. Hi, Luke. Question is probably overdone to death, but do you see a global recession as a foregone conclusion, EU, Asia? How about the U.S.? In the EU, yes. I think the odds of a recession there are extraordinarily high. They have gone about effectively attempting to commit economic suicide vis-a-vis what they've done with energy. Asia is a maybe, very possible recession. And if the EU just keeps doing what they're doing, if the Fed does not reverse course and begin growing their balance sheet again, I think the U.S. will be in a recession on a lag. Just given my career, I remember in late 90s when Asia Pac was 5% of sales, 10% of sales for U.S. industrial companies. And so when the Thai baht got devalued, it wasn't going to be a big deal. The Asian crisis was not a big deal for U.S. industrials. 9 months later, U.S. industrials were in a recession. And that's when debt to GDP was lower, debt levels in the system were lower, Asia was way smaller, the system was less interconnected. And so to me, I think it's highly likely the EU has a recession. If the EU has a recession, unless the Fed reverses course, it's only a matter of time till the U.S. has one. It's just, there's so much leverage. EU is huge as a trading partner. I think it's fait accompli unless the Fed reverses course. And as you guys know, we think they're going to stop tightening no later than the end of 3Q22. Will that be early enough? I don't know. Unless they renew QE, it might not be. JP, can you explain how the ruble and Russian oil and gas are interrelated? Sure. Effectively, they've used oil and gas to create a short squeeze in the ruble. There's very little float in the ruble, and there's a heck of a lot of demand for oil and gas. I mean, the Europeans are importing $150 billion a year of Russian oil and gas, and Russia's saying, hey, only rubles. And yes, there's a conversion process. They have to go to Gazprom Bank and change them into rubles, but ultimately that puts the value of the ruble completely at the control of the Russian central bank. Is Gazprom Bank going out and buying rubles in the open market? Are they getting them from the central bank who are creating them? At the end of the day, depending on how that goes, Russian central bank has control of the ruble, not the U.S., as the U.S. had hoped with sanctions. From Chris. Hi, Luke. Could the U.S. mandate U.S. stable coins to be backed by treasuries to give the stables the all clear to be used in U.S. transactions? Could be the new buyer of treasuries the U.S. government desperately needs? It's a great question. A couple people asked it in the thread today, so I appreciate you guys highlighting that. On the legal side, I don't know if the U.S. can mandate that. I suspect they can, but that's just not my bailiwick. I would defer to someone who would know the legalese, if you will, of that. However, if they can, then yes, in my opinion, it would be akin to the money market fund reforms or MMF reforms that the U.S. implemented in 2014. It was passed 2015-16. They went into effect. But what those basically did was force the multi-trillion-dollar money market fund industry in the U.S. They didn't have to buy treasuries. I don't want to misspeak. Treasuries were given favorable treatment for regulators relative to gating in times of stress, and I think maybe even relative to capital or bailouts. But I know definitely as it related to gating. And so the point is they didn't make the money market fund industry buy treasuries, but they definitely encouraged them via regulation, and they responded. You saw a massive increase in treasury money market funds. And who was the loser here was, you can go back and find articles in the Journal and elsewhere at the time, that the cost of capital in money market funds, in dollar money market funds around the world went up. LIBOR went up. The U.S. government basically crowded out global money market funds. And so I think this would be something similar structurally, if I'm understanding it properly, and effectively be tapping the global crypto buying pool, capital pool for treasuries, which I think it would be brilliant. It would absolutely, I think, drive more capital into treasuries, short term in particular. However, it would also undermine other bond markets around the world to the extent that we continue to have this inflation. There's going to be money out of bonds into crypto on the margin. Then U.S. Treasury still getting their cut, at least in short-term paper, but the rest of the world, the rest of the global dollar bond markets going to be borrowing more, and that ultimately means either you have a crisis or you have a central banks getting more liquid to fight that crisis, which is going to encourage more money into crypto, which is it turns into a virtuous cycle for crypto and short-term treasuries, and it ends up choking off capital from competing dollar borrowers like we saw in the money market fund example in 2015 and 2016. So with that, I'm going to wrap up for today. I appreciate, as always, you joining me. If you want more information about what we're up to, check us out, FFTT-LLC.com. You can find out where we're at, etc., and learn more about our Tree Rings weekly piece, 10 most interesting things, quick synopsis about what grabbed us about that particular anecdote or anecdotes, and whether it's confirming or refuting the way we were thinking about something prior to having read that. So with that, I'll sign off. Everybody have a great rest of your week. Look forward to chatting with you soon. Take care, everyone.